Hello, everyone. My name is Muhammad Syukur. Today, I'm going to present you my paper with the title "Relationship Between Ownership Structure and Tax Avoidance: A Moderating Role of Audit Report Lag." This research is actually part of my thesis, and this conference paper particularly, is a collaborative research with Indonesian researchers. So, why tax avoidance? So Indonesia and Indonesia's government have been facing a falling trend of tax collections, despite several tax amnesties and remedies have been launched. The government, the government of developing countries like Indonesia are dependent on tax revenues, especially on corporation income tax, because corporations are the biggest and also the most significant taxpayers for the government. And based on the report of Tax Justice Network in 2022, the corporations are actually um, aggressive, are doing aggressive tax avoidance. So people might argue that tax avoidance is legal. So what's the issue? So tax avoidance indeed is legal, but it leaves some concern for the government and also for the society, because for the government, tax avoidance would limit them to limit their access for the tax revenue, and they of course they want to collect a lot of tax revenues because they want to use that money for their programs, for the nation developments, and so on and so on. And for the society itself, tax avoidance is concerned for them because they believe that tax avoidance is an effort to minimize to pay minimal taxes. So minimal taxes means less contribution to the nation. So it's kind of like people who do tax avoidance are less nationalist. So in this case, in the context of Indonesia, where the ownership structure is concentrated, so the shareholders would have a very powerful influence to take decision. In this case, to do tax avoidance. So as the ownership structure in Indonesia is concentrated on family, so family shareholders have the power to exercise tax avoidance strategies at the expense of other shareholders. And to our interest, we want to see audit report like, we want to use audit report like as the remedy for Indonesia's context. So the main questions of this research is, how does family ownership affect tax avoidance, and what role does audit report lag play in moderating this relationship? So the literature for this presentation, I would like to focus on the key theories. First is entrenchment theory. So it implies that family shareholders or family controlled firms might be entrenched to their natural behavior of avoiding tax and maximize their personal wealth. And for the alignment theory, so we believe that corporate governance, in this case audit report lag, can help align shareholders to the other stakeholders' interest, and then to enhance transparency and reduce tax avoidance. So we have two hypotheses in this case. First is family ownership has a positive relationship with tax avoidance. And the second hypothesis is that audit report lag moderates this relationship. So now we are on the methodology. Here is the variables of the study. So the tax avoidance, we use two measures. First is effective tax rate. Another one is the gap between statutory tax rate and effective tax rate. So for the ETR, it has inverse indication of tax avoidance, means that higher ETR means lower tax avoidance. But the SETR gap, in this case, higher gap means higher tax avoidance. So for the independent variable, which is ownership structure, we choose family ownership because family ownership is a concern in Indonesian situation. So we use the ownership level in terms of percentage to measure the family ownership level. And for the moderator, we choose audit report lag, and it is the number of days auditors need to audit firm. And control variables, we include two, corporate governance mechanism, and also financial indicators. For the corporate governance mechanism, we choose board meetings, board independence, and board size. And for for the financial indicators, just capital intensity, long-term leverage, ROA, and also firm size. And our sample is companies listed on the Indonesian Stock Exchange, but we exclude financial sector firms because this sector has very specific regulation. And also we exclude the real estate investment trust because they are profit, the profit is going through the owners. So their effective tax rate of that business, of that company, is almost zero. And companies, we also exclude companies with negative pre-tax income. And then we have two data sources in this case, we use annual reports and financial statements. We manually collected information such as corporate governance and also ownership structures from annual reports. But for financial statements, we download from the financial database such as Acon Refinitiv. And we choose panel data regression to analyze our data. And the results has found that we have sufficient evidence to accept hypothesis 1, because as you can see here, family has a negative relationship with ETR and positive relationship with SETR. So meaning that the family ownership has a positive relationship with tax avoidance. So higher family ownership, higher tax avoidance. And we also have sufficient evidence to accept hypothesis 2, because as we can see here, the interaction between audit report lag and family here has a positive relationship with ETR and negative relationship to ICETR. So meaning that the audit report lag can moderate the relationship between family and also tax avoidance. But for the result for the control variables, there are mixed results. In this case, depends on the ETR and SETR. And we would like to conclude that family ownership is linked to higher tax avoidance, but an extended audit report lag or an extended audit process can moderate this effect by promoting transparency and strengthening governance. So we have two recommendations here. At least first is family-owned businesses in Indonesia may exhibit aggressive tax avoidance, but even though tax avoidance is legally permissible, but it can goes beyond permissible area. So we call that as gray area. So to avoid that, we should tax authorities should exercise careful process to ensure compliance remains within the lawful boundaries. And we also recommend that to mitigate potential aggressive tax strategies, a more extended and thorough audit process should be implemented. And we have 3 future research recommendations or suggestions for future researchers. First is that future research should explore additional tax avoidance proxies. In our study, we cannot explore more because of the data availability that we have. The second one is that future research should consider industry-specific effects because shareholders might behave differently on tax depending on the industry where they invest in. And the future research should also examine other moderators because it is good if we can find more moderators to minimize the aggressive tax avoidance of shareholders. At last, we would like to thank Institute Pengajian Siswasa or IPSIS of Universiti Teknologi Cawangan, Kelantan for the conference support fund. And so we also like to thank you, the committee, and also the reviewers of the International Conference on Business and Social Sustainability 2024 for the contribution. And we also thank you for your attention. If you have questions, you might tell us and deliver to us. Thank you very much.